Hi everyone, my name is Villain. I'm head of socials at Luna PR, and today we've had some incredible panelists and some good discussions. We've touched on DATs, we've touched on yield, we've touched on different ecosystems, but now we're going to dive a bit deeper on unlocking yield from DATs, right? So we have three incredible panelists here. I'm going to let you guys introduce yourselves.
I am Evan Su. I am with Gamma Prime. We do tokenization of hedge funds.
My name is Patrick. I'm the Chief Investment Officer of CETA Network Group that's listed on NASDAQ. Last month, we purchased $230 million of BTC, and hence the DAT Summit here is just the right forum for us.
Hi everyone, I'm Stephen McIntosh. I am the CIO of SUI Group Holdings, which is on NASDAQ, and I'm also the co-founder of Caratage, which is a large proprietary hedge fund in crypto.
Beautiful. Patrick, that was a very good, cool comment you just dropped there. You bought 230 million of Bitcoin, and we're going to go a bit deeper into that. But I guess I want to start off by saying that for years, the focus has been on holding Bitcoin, right? You're buying Bitcoin and you're holding Bitcoin. Now it's about earning it. So what's driving that shift from holding to yielding in digital asset treasuries? And I guess you can start off, Patrick, because you just bought 230 million of it.
Yeah, that's a $230 million worth of question here. To start off with, obviously from us is we have moved on, DAT or buying or holding Bitcoin or digital asset. This is not an experiment anymore. We are transforming from holding and buying digital asset onto looking for yield-bearing products. However, the problem of us, for us being a listed company, is that there are limited supply. It's like a demand and supply of products, yield-bearing products, institutional-grade products, compliant products that for us to buy. It's like you going into, can you imagine, going into Bloomingdale in the Dubai Mall, you can only buy 5 pairs of shoes. You can only choose 5 pairs. That's the problem. Vinan, I'm sure you're going to have it, right? For us, there are limited supply, and we're looking for more products out there that are worthy enough for us as a listed company or a corporate, public, or private company for us to accumulate our asset, our treasury.
That's a good point. And Stephen, even feel free to add on if you guys have any points to add on to that.
Yeah, I think, with all of these public companies, the most important thing is that you should have operating revenue in the business. Ultimately, if you don't, you really are kind of not too dissimilar to an ETF, right? What's the point in holding the equity in the company? Therefore, you're backing a management team to drive a return on that balance sheet and to be extremely aggressive commercially in how you identify other ecosystem opportunities within your native token. So for us, it's SUI. We are the only SUI DAT because we are the official SUI DAT. We did it in partnership with the SUI Foundation, the creators of SUI. And since we've been live, we raised 450 million to kind of convert a company that was a non-bank financial lender called Mill City Ventures. We rebranded it as SUI Group Holdings, and we are pursuing a public token accumulation strategy. But more importantly, we're also building infrastructure. So recently, we announced that we will be issuing 2 native stablecoins on SUI. SUI USDE and USDI. These are white labels of the Athena stablecoin. When Guy from Athena proposed to introduce Athena to the hyperliquid community in the summer, which was ultimately rejected, I saw that as a huge opportunity for the SUI ecosystem. We were already an investor at Caratage in Athena and have a very close relationship, and so we actually brokered that transaction, and we, as the counterparty, SUI-G, to the issuance of that stablecoin means that 10% of the fees go to Athena, but 90% goes back to SUI-G and the SUI Foundation to buy back tokens in the market. And that's really interesting because all of a sudden, SUI-G has now got stablecoin equity exposure. And if you want to buy stablecoin exposure in the public markets, you can buy Circle, maybe you can buy Coinbase, that's about it. But now you can buy SUI-G. So that's number one. Number two, we also have done a very interesting lending agreement where we lent part of our balance sheet to Bluefin, the leading perps DEX, on SUI in exchange for a revenue share. That yield coming back to us, that's over and above us already staking our tokens. And so as we kind of look into the first half of next year, SUI Group will be announcing similar initiatives where we are extremely innovative in doing ecosystem partnerships and deals that are either DeFi related or infrastructure related, whereby our shareholders get way above the, call it, benchmark staking yield for the SUI token. And ultimately, that's why you would own our stock. If you believe in SUI and you believe in the explosive upside of this token to be, perhaps the most performant L1 in the next 5 years, but you also want to capture all of that ecosystem exposure, all of that value generation in DeFi, in stablecoins, then you should come to us because we kind of deliver that through our equity.
I would add, we're big fans of SUI. Gamma Prime is actually going to be making SUI our home chain. And I would say, to answer your question right on the nose, yield is the differentiator. Otherwise, you're just buying and holding Bitcoin. Why do I need you for that? If that's what you're doing, then I'll just do it myself. The difference is, what do you do with that asset? The difference is the type of yield that you generate. What's the risk profile underneath that? So, personally, I have a short spread on of pure DATs. If you just buy Bitcoin and you have some premium, I expect that premium to come in. So, if this, you do a delta neutral trade where you're short the like that and you're long the underlying Bitcoin. But I would not do that with something that generates yield, because that's something that can last. That's something that's for real. It's a little bit like do you remember SPACs? Where they're like accumulate $10 million and they go buy a company. Why would that trade for $11 million? That's just going to come back in. And that's what we're seeing right now. And if you use SPACs as an example, it overshot the other direction. It went actually almost 40% discount, right? That becomes a buying opportunity. Right now we're at about par, right? MSTR is about par versus value, and it's come in 40%. Is it going to stop here? Well, look, if you have underlying yield and generation, that gives you up thrust. That gives you something that makes it worth more than just buying the token by itself. If you're doing some crazy thing where you're just buying more because there's a premium and then giving some dividend out, I think that's called a Ponzi scheme.
It's a dangerous word in crypto. Sorry, Patrick, go ahead.
No, I think among us, the audience is like DAT, digital asset treasury, right? I'm taking it from a different perspective because these are ecosystem builder. From my perspective, we are a listed company on NASDAQ. Our operation, and I think that came back this morning's topic, right? You need to have a fundamental business. And our core business is actually in Bitcoin mining, in the upstream. Obviously, from us, coming into the midstream, where we acquire Bitcoin, right? $230 million worth as a first batch. I mean, what do we do with it? I think the key to this is that, are there any downstream player where we can work with? Because I need a partner that can help me generate yield. We're not talking about retail yields, right, from the utility tokens. We're talking about institutional grade, right, kind of yields. I mean, this is where we are focusing on among the adults. And as a listed company, looking for institutional that are safe, compliant, transparent. That is the most important part for us. Yield is actually the second part I'm chasing after. So long that you can provide me, well, you can talk about 40%, that's great. Am I going to report to my board saying that, okay, this is the product. As a CIO, I need to make sure these are right, whether you are traditional or digital, right? 40%, how do you get there, right? Has to be safe, has to be compliant, and has to be transparent. I mean, that's very important to be disciplined to do this. But what I'm seeing and where the debt heading, and I dare to challenge everybody, I see the lack of products out there. I don't see a lot of builder that can tokenize a lot of these products. I don't see a lot of private credit. In fact, I actually met, a real asset tokenization platform over there, right? She focus on tokenizing, yield-bearing products, private credits. And these are exactly what I'm looking for. The typical, what you're seeing in the BDC, the yield you generate, may not be enough. But I'm looking for high yields, but more importantly, the word have to be compliance in what we do. I think that's where we're heading into DAT 1.0, into DAT 2.0.
Thank you. And I think you mentioned something about institutional yield and retail yield, and I want to take you back to that and I almost ask you to explain what's the difference between institutional yield and retail yield, and why is it important for DATs to really differentiate between those two?
I look at it, rather than putting on a digital, I'm looking at the traditional world. There are retail investment where you go to a bank, you have a product shelf where you can simply pick up, right? We call it in the banking terms, professional investors holding of $1 million and above. Then you can buy a certain things like, VC funds, private equity, or certain higher risk, right? Obviously, higher risk, higher return, but they expect you to be more sophisticated to understand these products. Institutional grade, in our mind, is compliance has to be top notch. Yields has to be better, but however, it's accountable. It has to be safe. Retail, in what I'm seeing right now in the retail yields, a lot of them are generated from your utility tokens, right? These are, I would say, still a long way to catch up. From a professional investor perspective, right? These are the fine details and the extra scrutiny on what we can invest in and what we cannot. And I think institutional grade is the key word for us. And I have high conviction, the more builders out there, especially tokenizing the institutional grade treasury products, the better for all of us in the audience here.
I would agree with that. I think it's the gateway to bring in new capital, right? This is what we all want. It's like, it shouldn't be the same retail capital just going in a circle. The thing that's going to make the industry grow is when it becomes regulatory compliant. Look at what's happened with Bitcoin ETFs, futures. It's created a whole new influx. That's what the industry needs to grow. And to do that, you got to meet them halfway. You can't be like, we're just going to, it's all like, you can just look at the smart contract. It's like, they don't know what that is, but they understand when something has an auditor, right, and has web. And we say those are not incompatible with each other necessarily, right? They serve different purposes. If you have, blockchain's really good at immutable ledgers. It's not really good at preventing fraud, like FTX and Terra Luna, right? And those are things that Web 2 protections are really good at, right? And FTX was just basic stuff. Don't intermingle funds. That's not your money, right? You're a custodian. But in crypto, there's no concept of that. So what will happen is if you don't solve that problem, institutions will never come in. They're like, you just took money that I trusted you and you went and bought a Lambo with it. That's like basic economic 101 illegal, And if you're going to do that and have no protections against that, we're not going to touch this. I don't care how good your yield is. All right. So you need to meet them halfway. And it turns out it's not that hard, right? And this is where I think the tokenization world is going, the difference between tokenization 1.0, which is just Wild West, it's all on-chain, digital native assets, to these things that are reg compliant, that an institution will go, yeah, I'm good with that. And the extra yield, that's what's now attractive, because it's just as good on the compliance side.
And I think looking at the third party, because I'm looking at a lot of third party builders out there, ecosystem, you are all contributing to the entire ecosystem driving forward, right? And if you can start with the mindset of being compliant, that's a good start. You can chase it at any time, right? However, if you build your API, you build your platform with a compliant mindset in mind, in mind, number one. Number two is you are already interconnected to a lot of crypto exchange, whether connected to a lot of different partners. Actually, less work for me. And for me to pick a partner, I have to make sure I don't need to do much work. I just have to trust you. And actually, I talked to another person here right now. All the products, all the providers are pretty much the same, right? They offer the same product, but sometimes a little finer detail, right? Simple, right? User-friendly, right? However, it's also who is backing you is also important, where you can leverage on the partnership and the relationship. However, being compliant in mind, transparent, and everything built from that, that's very important. Less work, for everyone else. You just entrust that partner who help you to build the tokens, the products that you need. And I think that's where we need to go for the next, going forward, especially from your perspective, because you are also building that, right?
Yeah, I think, it all comes down to like what investors are getting exposure to, right? With us, it is the only way to play SUI in the equity market. And more importantly, what does SUI stand for? Well, SUI is a very differentiated blockchain opportunity. I say that having invested in, almost close to 90 companies over the past 7 years at Caritage. SUI is an object-oriented blockchain. It was originally conceived at the Facebook Libra team, which was shut down due to kind of regulatory issues in the previous administration. Had that business been allowed to flourish, both Libra and DM, the stablecoin initiative, it's highly likely that that could have been the biggest business in crypto with Facebook's distribution, bigger than Tether, bigger than Coinbase. And you get to buy into that team, right? They invented Move, the smart contract programming language, whilst they were at Facebook. And, it really is very different. Putting aside Bitcoin for a second, every blockchain that you kind of see a DAT for now, Avalanche, Solana, Ethereum, they're all account-based models, which is a very kind of, call it first innings blockchain architecture, because it's just really kind of ledger in-out balance entries. Imagine, for an analogy like that, everyone on Black Friday has to settle through one till. That's an account-based model. Whereas an object-based model, an object-oriented blockchain, every merchant, every asset can have its own till. It can scale infinitely in parallel. And why that's interesting is because as we look to the future for this kind of intersection of where crypto meets artificial intelligence, it's highly likely that somewhere like SUI will be the home of agentic commerce, where agents can be objects. The assets they hold can be objects. They can transact at really kind of like high throughput, which is what's needed, because the order of kind of magnitude increase in transaction throughput that will be accompanying the agentic commerce explosion is a lot more than we have today, and a lot more state than these blockchains can hold, and that's what SUI was designed for. It's a blockchain optimized for the future. It's a blockchain optimized for AI and agentic payments. And, in the kind of 3 or so months since we've been live, many of the investment banks have started to pick that up. Both Cantor Fitzgerald initiated coverage on SUI-G recently, put out this amazing 46-page equity research report on why they think SUI is the way to play the agentic blockchain future, and why SUI-G is the equity you hold to get that exposure. Similarly, we have a number of other kind of investment banks initiating coverage at the moment that will come out in the next few weeks. And so these institutions are recommending SUI-G as a way to get exposure to these breakout phenomenons. That's the first thing, right? That's why people want to own your stock. But as I mentioned before, unless you're really building infrastructure, giving unique exposure above and beyond the token itself, whether it's stable coins, whether it's DeFi yield, you're just not going to win. In fact, I think that a lot of these DATs that have really done nothing since they've gone live will go to zero, because unless you can innovate, unless you can do what we're doing, which is be like a economic actor in the blockchain ecosystem that you're from, what do you offer?
That's fair. And I think all three of you touched on regulation and you touched on scaling. And I kind of want to stay on that for a bit on the regulation side of things. I think it's fair to say that regulation has changed a lot in this space over the last couple of years. And when you zoom out for a minute, you can see that the markets have matured a lot, right? When you go back to 5 years back, 2 years back, even from 2 years ago, the markets have matured a lot. So I guess my question is, how should treasuries today think about balancing the upside of yield with sensible risk management?
Well, I think the reason the DAT phenomenon, the reason it's the DAT panel this year is because of the regulatory environment, right? We live in a post-Genius world and soon a post-Clarity world. That's what has allowed this proliferation of, kind of public markets, kind of crypto opportunities. It's why the Circle IPO was such a rip-roaring success. It's why we have a number of IPOs slated for 2026, Kraken and custodians like BitGo and others. 2025 will be a landmark year that will go down in history when Wall Street was finally unlocked, right? Maybe to answer your question specifically is still an issue is that, are you as a DAT company driving operating revenue, or are you an asset manager? Because if you're the latter, you're going to be in breach of the 40 Act. And I think many companies will run up against that unless you really have substantial operating revenue in the business.
I don't know if you guys realize how far we've come on a regulatory side. But in the past administration, there was a reporter that asked Gensler, as the SEC had, so do you think we need more regulatory clarity? And his response was, we have regulatory clarity. I just sue whoever it is that I don't like. Like, that's pretty much what he said. His idea of regulatory clarity is, if you get on my radar screen, I will just go after you in court. And think about that versus what we've come all the way to where we're like, hey, here's an actual law with something specifics that you can follow. I mean, every business owner is looking for that, stability. It doesn't matter what that is, they just don't want it to be capricious and arbitrary, right? And that's something that, fortunately, we're moving towards.
I look at, as a listed company on NASDAQ, I mean, I also came from a traditional finance background. I think we should approach this, it's not like a digital, asset company or traditional. We should look at it as a traditional company. You need to be compliance first. Risk management, I think yield should be second, right? What we need to focus on is the exposure limits that we set a cap, what we can expose ourselves into the digital asset. It is volatile, but then again, hey guys, stock market is volatile as well, right? You need to have very disciplined about how you take care of your risk. I mean, this is what you do, whether it's you're investing in digital asset or traditional asset, you apply the same principle and discipline. So, when you apply those discipline principle of how you allocate your resources, a lot of people are allocating a lot of money, right? You need to apply it the same way as what you do normally, right, in the corporate environment. And then the yield will come if you do this right. So from my perspective is, yes, yield is important. I mean, everybody focus on yields, but more importantly, you need to set the limit first, and then you take it from there. When you are in a compliance environment, you don't have to worry about SEC knocking on your door. I mean, that's what you don't want at night.
I feel like just think about how much the conversation has changed, right? Now we're actually talking about companies with real revenues and actual businesses that have a genuine product market like niche that generate value and therefore actually generate returns. We've come such a long way from mooning coins and hype and community like that. I know there's some people that are kind of hanker for the old days of the Wild West, but this is the industry maturing. It's really, really good for blockchain.
One thing to add is that the reason why we have maybe DATs is because we have foundations. And foundations are like Swiss nonprofits or Cayman foundations. Again, that is a legacy hangover from the previous regulatory, unclarity, because you weren't sure whether you were a securities company or whether you could operate legally in the US. And in many respects, I think that the foundation model doesn't make any sense. That's not how you build like a high-performance Silicon Valley tech company, with a Swiss nonprofit. OpenAI maybe is the canonical example of that, right? You should be a commercial actor. You should be a capitalist organization, and that's what we are. We are the capitalist arm of SUI. We're the capital markets arm of SUI. We are there to do things that a foundation can't do, doesn't want to be seen to be doing, and that means that your appetite for return is huge. You're focused to drive return for your shareholders, and I think that. In many respects, in the future, let's see how the next few years play out, but it's not unthinkable that a DAT like us could buy Miston Labs, the founders of SUI.
Yeah.
There's no reason that couldn't happen because we are a public markets entity. We can tap the capital markets for liquidity. We can be aggressive and value accretive in M&A for our shareholders. And in many respects, what you could become is something akin to a bank. I call ourselves the SUI Bank. That's our goal, to be the bank of SUI. We should be the home of liquidity, the home of lending. We should use our balance sheet for return for our shareholders, but also to drive economic return in the SUI ecosystem, to king-make protocols, not to be a business that provides grants to 50 different DeFi entities, to pick one and to make them a winner in the whole industry. That's what you can do. And that's like what a capitalist organization does, right? So I think that's part of the maturity here, is that as the regulatory path has become cleared and we can express the true direction of these crypto companies, they should be focused on economic return.
I think the word is evolution. What you're saying, I think that's also touching on a very good point about have to be becoming an operator. You need to have a fundamental operational business first. I mean, like SUI, you already have that fundamental. I think adding that treasury, the digital asset, is icing on the cake. I think that's important to have a fundamental business. I mean, from our perspective, we started with Bitcoin mining. Now we're venturing into, the treasury part. The next part is how can we use this treasury even better, driving more return? Because my fiduciary duty is for my shareholders, just like everyone else here, right? But however, I think it's important for us changing, right, from 1.0 to whatever, just like your iPhone, right? You're starting iPhone 10, and you have more features now that you are iPhone 17, right, with faster camera speed and all that. And it's the same thing as what you're seeing in the entire ecosystem of DAT. We are evolving. We are changing for the better. You cannot just one step and all the way out. Just like the traditional market, even the NASDAQ, the SEC have rules changing every day, right? We just have to make sure that, we stay focused and making it even better for the entire ecosystem builder.
That's very cool. I think at one point, all three of you flirted with the idea of talking about RWAs. So I just want to take you guys back there for a second. How do you see tokenized treasury bills and RWAs fitting into the yield equation for DATs?
I'm going to take a stab at this first then. I'm a strong believer and a big believer in RWA tokenization. The fact is that there are limited supply and demand out there. Just like when you imagine, when you go to a bank right now, you see a product shelf, right? You see a lot of traditional wealth management products that you can buy offhand, right, off the shelf. However, when we're looking into the digital shelf, there are very limited options. And I think what real-world asset tokenization, what they do, there are a lot of people can provide you with yields, right? That are very sophisticated product. However, not many builders that can tokenize it and with a distribution that allow us to venture into, to acquire them. This is not retail, this is not retail play anymore. This is institutional grade, sophisticated. If there are more real asset tokenization builders out there that with a compliant mindset and that they have distribution, everything integrated, that's the best for everybody. That is where you chase the yield. This is where you find yields because there are more products out there, more sophisticated, more diversity, and that's for the better for everybody.
I'll tell you, the word that pops out for me in what you just said is distribution. It's not actually a tokenization. Now, we have tokenized hedge funds on the platform, so this is a bit of a radical view, but we sort of feel like tokenization by itself just doesn't really matter. Why? Why do you tokenize? It's what it does for the business that matters. Does it actually provide something of real value? And look, this is not a popular view, but I look at some things like tokenizing in treasuries, and I actually think, why? You already have a token-like experience. You can buy fractions. You can buy it electronically online, and it's free now. You can get portfolio margin across the whole thing. You can remix it. Why? What does it add? It needs to add something. So I'll give you an example of an area where we've seen it add something interesting, is freight, like advance payments, because it's an extremely liquid market, and what happens is it allows people to get paid, or truckers to get paid in like 90 days earlier, and then for somebody to be an intermediary to buy that risk off of them. That's solving a real problem. Now that's something that most people don't know about. They're like, oh, yeah, freight tokenization, that makes sense. But that's the sort of thing that's going to drive this, where someone's like, they didn't even realize it's being tokenized. They just know I'm being paid right away. It costs me a little bit. And versus before, I get paid 90 days. If you're a trucker, you're a small business owner. You essentially, 90 days to get paid is horrendous. They will gladly pay a premium to get that right away. It's called receivables lending. Amazon has the same thing. People have 90-day net. Well, if someone's willing to bridge that gap, they get that yield, and then the person gets what they want, which is the cash, and they cut the risk. That's a real value, right? So, I think there's a bit of a situation right now where we have hammers looking for nails. Right, we have this tool called tokenization, and people are like, yeah, look, it works so good for dollars, stablecoins, right? That's essentially, it's a tokenized currency. But it solved a real problem. That's why it took off. It's not because of the tokenization. It's because when I send money from Singapore to Romania, it took 2 days and cost me $85 because there was a $30 fee on the backside, another $15 on the intermediary, and another, and then now it goes through like instantly, it cost me $1.80. That's a real value. So that's the sort of thing that we need. And if you go around tokenizing things thinking that's what's going to magically create, some sort of benefit, I say good luck with that.
Okay,
I
so
think adding one more point to that, I think what tokenize, it comes with it has to be liquidity. Everybody needs to know that, right? Tokenizing something with no liquidity, you may as well not token it. You're just sitting on your desk right now.
That's why you need the distribution.
Correct, right? Distribution, that's why, whoever can build that with distribution mindset, compliant mindset, that's very important because you need to think about us. You need to think about the end user. We need liquid. We can't just buy something and sit on it, right? That cannot offload, right? However, but then you talk about because the tokenization, because there are still products out there normal people cannot buy into. Like letter of credit, I'm not sure a lot of people are in the world commerce. There's a letter of credit, that's big market. No one is tokenizing that. Trade credit, that's big business. If you can also tokenize that, that just create more diversity on the product shelf that we can get ourselves. Because at the end, we all want yields. We want it safe. We want it quick. We want it liquid. And I think there are more. We need more builders out there. We need the good one that can help us, for the better.
If I may make this concrete, because we're like, oh, we need distribution. What does that mean? Okay, that's pretty much what we think the strength of Gamma Prime is. So I don't know. Did any of you guys come to our event? Like, a few people came. We were the biggest event in Abu Dhabi. We had 13,000 people come to the event. We had 3,000 people in live and 10,000 online. We were also the biggest event in Token 2049, also 3,000 people. People are like, why do you do this? Are you an events company? It's for the distribution. If you don't do that and bring large communities of people together, then you don't get that mass effect, right? You don't. So, and it turns out the community loves it because they're like, oh, this is a great event. It's kind of serious, It's like people here are actually seeking yield. They're seeking actual businesses. And so what we do is we do tokenize hedge funds. Yes, we do that. But we're like, that's not our thing. We may not even use our own engine. We'll probably use someone else's. We are a distribution company. And that's the thing we do better, literally, than anyone else. 13,000 people, just to give you a sense, is the size of ETH Denver. So, and we just started in February. So our specialization is not actually tokenization. It's the marketing. It is the distribution. It's the outreach. It's also why we love SWE, because you guys really have partnered with us on this aspect of it. And that's the sort of concrete example of what it takes to build something that's going to then drive the tokenization part of it, and then as a result, move it forward. It's not the tokenization in and of itself. At least that's not what we think.
I think, Nikita, next summit should be RWA Tokenization Summit. Because I think that is where where you're going to see the DAT, 2.0 or even 3.0 will be, because
we're the Tokenized Capital Summit.
Awesome.
So,
I think that's where the next focus will be. I mean, that's where the growth. All right, let's do it.
She doesn't work for us, by the way. But yeah, Hong Kong, February. It's a very fun event. It's free.
So, Evan and Patrick, I think you guys kind of answered my last question, which was going to be a quick-fire one. So, Steven, I'm going to give this one to you. It's supposed to be a quick-fire one, so just give us the first thing that comes to your mind, that it's finally looking ahead. What does the next generation of yield look like? Will it come from staking, tokenized debt market, RWAs, or something entirely new?
It will come from giving investors access to the thing that they most singularly want. So right now it's stablecoin exposure, stablecoin yield.
Beautiful. Ladies and gentlemen, thank you very much. That concludes the whole panel.
Thank you.